everyone. It's been a while, and I'm sure many of you have been busy. I've been very busy, also because the stock market has also been a roller coaster, which means the economic activity has been a roller coaster. And hopefully today I can provide some wisdom, if not for you, for myself, because I did research for this video. But the big thing here is that over the past year, we've seen the S&P 500 fluctuate a lot, and we've entered bear market territory. And every so often, I get a little hopeful that we're going to recover, get out of this bear market, and go straight into growing again. But we're not quite there. Every time we go up, we sink a little bit further down. So it's quite the adventure and a roller coaster that seems to be trending downward when we look at the graph. But hey, you can always feel better if you look at the historical data, which we will in a little bit. But first things first is, why is this happening? Right? Why is the stock market getting all crazy? Why are we losing money? Folks can agree that inflation is a major cause of the economic situation that we're seeing and why the stock market is declining. Now, the important part to call out during inflation is that because inflation is high, the Federal Reserve feels the need to increase interest rates, which reduces demand and in a way reduces inflation. Right? When they increase interest rates, they're basically pausing or putting the brakes on the economic activity of the United States, which also puts a brake on the economic activity of the rest of the world. The Federal Reserve has gone on record to state that it's going to be painful, we're willing to suffer, which to me translates to basically, hey, they're willing to put the economy through a recession if it means putting a stop to inflation, which arguably, could be a good reason depending on who you're asking. Increased interest rates are great, but can we just address the cause of inflation? Well, we don't really know, right? We don't really know what's causing inflation. All we can say is that, this war is happening. Could be the cause of inflation. One thing that could be the cause. These issues with supply chains could also be another cause. Could also be hypergrowth that we've been experiencing after we came out of the pandemic or for the past decade. You could see many arguments and many reasons for it. It's really hard to pinpoint an exact reason, and it's really hard to decide, hey, this is the cause of it, I'll fix it and everything will go away. And also you'll notice that all the reasons I mentioned are not easy fixes. You can't just say, hey, I'm going to fix all the supply chains issues globally and we should be in a better place. Really difficult to do. But all we know for sure is that we need to reduce demand, which will, in theory, reduce inflation. We know bear market's terrible, but on the bright side, this has happened before, right? It's historical. We've seen bear markets in the past. We've seen recessions in the past. This is nothing new. What might be new is the cause and the unique combination of factors leading to it. What's not new is that bear markets have happened and we've ultimately recovered from every one of those. The most recent one being 2020 due to the pandemic. It's important to understand that the US economy is cyclical. What I mean by cyclical is that it goes up, it goes down, and it goes up and down, right? The pattern repeats itself. The US economy, in a sense, like they have recessions, but when they recover from recessions, it does better than before. Right, so the economy still continues to grow even with all of these recessions. And when the economy grows, the stock market also grows with it. Now, depending on how you measure a bear market, for most folks, it's when the stock market has dropped to 20%. And at that point, we've officially entered into bear market territory. And bear markets can last anywhere between a few months to a few years. Right, when the market actually does recover, it continues to grow again. Now, the last 10 bear markets took somewhere between 99 days to 630 days to reach the bottom, right, or the trough. In other words, we fell for 99 days or 630 days until we started going back up again and started seeing a recovery. Right? It doesn't fall every day, like it falls down and up and down, but it just goes down lower. But on average, it takes about a year and 3 weeks for us to hit the bottom. We're nowhere near a year and 3 weeks. We're not even near a year yet. Personally, I think it's going to take a while. I don't think a year and 3 weeks is going to work, but who knows? We don't really know. No one really knows when it's going to hit the bottom. All we know is that, retroactively speaking, a few months down the line, we'll know we hit the bottom when we start recovering. We could be recovering right now, but I'm not going to say that because that's optimistic. Probably we're going to keep falling for quite a while. All right, so now that we have all the facts, what exactly can we do about it? It really depends on what you're invested in. Right? Depending on what you're invested in, different strategies will work for you. Personally, I'm invested in the entire stock market, VT-SAX, for example, but for simplicity, I'm going to talk about the S&P 500, which many folks are invested in. If you're invested in anything else, then these strategies may not apply. I'll talk about some of those situations. It's really going to be a case-by-case basis, but a good chunk of you should be invested in S&P 500, should have some money in bonds, international stocks, and so on. Now, the first strategy that folks talk a lot about, and generally is not a good strategy, is to withdraw all of your money. And in other words, you sell all of your investments. When you do this, you actually lock in your losses. Remember, if you don't sell, you don't actually lose, right? There's a chance that that stock will recover, that investment will recover. The second you sell, you're cutting your losses. And that has both a psychological effect in the sense that, hey, if you're selling now, you're probably not going to come back into the market. And there's been a lot of research done for folks who do sell during a recession. They don't come back before the recession is over, before the stock market has recovered. And when the stock market recovers, they're missing out on all of those gains. Remember, we don't know when the stock market has hit the bottom until we look back on it. And because you don't know, you're not going to invest again. And because you don't invest again, you're going to miss out on all of the gains during the recovery phase. So you're actually losing money by selling. You're actually punishing your future self if you sell now. But here's the caveat, right? Could be a key strategy if you have individual investments, right? If you invest in a company that you don't think is going to recover or come back from this recession, then maybe it's worth selling. Because if that company's not going to come back, or it's going to go bankrupt, or you think the mix of economic factors are going to mean that the stock price will plummet and never recover, then you probably should sell it. I can't tell you which one of those are, which company is in this category, but if you think your company's in that category, could be a good reason to sell. The beauty of the S&P 500 index is that it's the top largest 500 public companies in the United States. 10 companies fail during the recession or the bear market and they never recover, they'll just take the next top 10 and pull them into the top 500 because they're going to keep growing, right? That's why it's so important to own an index, because you don't have to make these decisions and try to understand, hey, which company is growing, which company is not. The indexes do it for you, right? The S&P 500 index does it for you. It basically picks the best companies that are approximated or they believe will survive because they're the 500 largest. They're not the same 500 largest pre-bear market and post-bear market. A good chunk of them will stay or a good chunk of them won't stay. Either way, the index is going to grow. Another strategy is to stop investing and to start hoarding cash. Now, this could be a valid strategy depending on how you feel about your own financial situation. When you stop investing, it doesn't mean you sell anything, right? So you still have money invested in the stock market. You still expect to ride the wave when the stock market eventually does recover from a bear market. The difference here is that you're hoarding cash, and ideally you'd be putting in something safe, right? Either high yield savings or certificate deposit or another safe investment vehicle. Could be I-bonds as well. But whatever investment vehicle you choose, it's safer than the stock market. And the reason why some folks choose to go with this is because they want to build a larger emergency fund, or they're saving for another financial event, whether it may be a wedding, whether it may be purchasing a home. All of these are valid events to start saving more cash. There could also be a secondary reason in the sense that it's very difficult to put in more money into the stock market just to watch it be negative the next day. Right? You don't want to put in like $100 and then lose $5 the very next day. Saving cash is a valid strategy, especially when you think about it in the sense of building a larger emergency fund. Right? Maybe you feel like your profession or your job is at risk due to this bear market, due to this recession, which we are seeing a lot of, right? There's been many layoffs. If you feel like you're in danger, then having a larger emergency fund definitely does help and provide you more time to find a new job when the layoff does occur. Spoiler, the next strategy is my chosen strategy in the sense that it's to keep investing. I'm not going to take money out of the market. I'm not going to hoard cash. I'm just going to keep investing, keep doing what I'm doing. And this is what most seasoned investors do. I'm not a seasoned investor, but I happen to gain nuggets of wisdom from seasoned investors and learn from them. And my understanding is that a recession, a bear market, it's all short term. Right? Nothing compares to long-term gains and having an investment philosophy and plan for a 30, 40-year period. And really understand, hey, what am I trying to get out of my investment strategy? Am I trying to grow my wealth for retirement? Am I trying to grow my wealth for other reasons? Whatever it may be, as long as you keep that same strategy, understanding the pros and cons of it, and understanding where it's going to get you in like a few decades, then you understand that this short-term event is probably not going to matter because historically speaking, the stock market grows over time. I understand that, hey, today I may see losses, but eventually it's going to recover and it's going to grow some more. And if I take my money out now, then I'm punishing myself in the future because the money won't grow. I trust the historical data, and some folks might not feel comfortable with that, right? You have to strike the right line of balance between risk and return. I mean, once you find that good balance, you can start thinking about how you can invest proactively. Many folks during the last recession considered it a wealth building event, right? 08 made a lot of people rich in the sense that if they invested in starting in 08 and continued to invest up until 2020, right? The stock market has grown a lot over that period of time, and a lot of folks made a good chunk of money off of it. People came in when the stock market was low and rode the wave up. I recognize that it's not the financial strategy or the emotional strategy for everyone. It's very important to speak to a financial advisor and to really understand, where am I financially? Now, if you don't know where to start, feel free to reach out to me. I'm happy to point you in the right direction. Remember, I can't tell you what to invest in and what to sell and what to buy, but I can tell you what I'm doing. And what I'm doing is to continue investing. I'm wishing everyone the best when it comes to navigating the stock market. I know it's difficult. I know that it's tricky. And I know it's a very emotional journey, just because it's difficult to watch your money get eradicated and then come back up a little bit and then get eradicated again. But it gets better, right? Historically speaking, it gets better. Whatever happens, if you're invested long-term and you have a long-term plan, it'll be all right.